Okay, we will start. So I think where we stopped, we discussed about money supply completely, right? Causes of increase in money supply, right? Okay. So next topic is Reserve Bank of India.
Sir, I have a doubt.
Yeah, tell me.
So here the reserve money,
Ah.
it is the money which is kept with the banks that out of the CRR and using all these statutory instruments only.
Yes. Reserve requirements.
Does it include the printed new money also?
No, that won't be included. Once it comes into circulation, then only it will be included. That is why I have told you, when the Forex is coming, when this money is printed and giving it to that foreign investors, when it is circulated in the market, then money supply will increase. But if it is with RBI, it won't increase the money supply.
So then why are not we considering the deposit money also having the multiplication effect?
The deposit money ultimately having this multiplication effect, but when it is with the banks, it is not having any multiplication effect. But that will be coming to the public obviously, because banks are lending.
Okay, when we are talking about deposit money, we are considering that it's parked with the banks only.
Yeah, it is with the banks.
Okay, sir.
RBI it's not deposit money.
No, not RBI, the banks.
Banks are deposit money we won't take, but this deposit money ultimately that cash reserve. See what the banks will do. Banks will try to lend maximum, right? Why banks are not lending? Only because of reserve requirements, banks are not able to lend. So banks keep the reserve requirement and lend everything else.
Okay, sir.
So that will come as a currency in the hands of the public.
Okay, sir.
Okay.
And so in that definition of reserve money, it is a total stock of all types of currency held by the public in banks at any point of time. Here the public means all economic entities except government and banks.
Yes.
Banks also.
Yes, government and bank.
Okay, sir.
Okay, any other doubts? Okay, next topic, Reserve Bank of India. You can write few lines there. RBI is the central bank of the country. RBI is the central bank of the country. That is the apex monetary institution. The apex monetary institution. It was established on 1st April 1935. 1st April 1935 under RBI Act 1934. RBI Act 1934. So 1934. So the act was in 34 and established in 35. When we talk about regulating Act of 1773, there was a provision of establishing a Supreme Court, and a Supreme Court will be established at Calcutta in 1774, like that. Okay, Act in 34 and established in 35. It was established on the recommendation of Hilton Young Committee. Hilton Young Committee. Okay. It was established in private sector with paid up capital of rupees 5 crore. So when it was established in the private sector with a paid up capital of 5 crore. Is that desirable? Establishing the central bank in the private sector? Is that desirable? Is this desirable in private sector, the central bank, which takes all the decision with respect to? No, it is not desirable. That time British government, they were not much responsible, so it was in private sector. Okay, so it was established on the recommendation of Hilton Young Committee. It was established in private sector with a paid up capital of rupee 5 crore. And then after independence it got nationalized. So you can write one line over there. It was nationalized on 1st Jan 1949. It was nationalized on 1st Jan 1949. So in 1949 it got nationalized. What do you mean by nationalized? The government purchased all the shares, right? Government purchased all the shares. So when it was established, like I have told you in 1935, when it was established at Calcutta. So when it was established at Calcutta, and in 1937 the headquarters was shifted to Bombay. Okay, so it was shifted to Mumbai later from Calcutta. In 1937 it was shifted to Bombay. Now what is the financial year of RBI? Financial year, what is the financial year? Any idea? This was a prelims question.
April 1 to March 31st. So July to June.
1st July to 30th June. So why this difference? Normally when we discuss about national income, or when we discuss about the case of banks also, it is 1st of April to 31st of March, right? In case of all banks, when we measure national income, normally accounting year is this. But why in case of RBI it is 1st of July to 30th of June? Any reason?
Because they will take time to review the compilations given by bank.
Yeah, first of all, if you keep this as the accounting year for RBI, towards the end of this year, RBI will be busy with managing and maintaining their own accounts. So RBI is a supervisor of all the banks. So RBI cannot, supervise the banks. RBI will be busy with their own accounts. So it is from, now first RBI can take care of these banks. RBI can supervise these banks, and then RBI will get time. So then RBI can manage that. That's why 1st July to 30th June. Okay, April, May, June. That 3 months RBI will get. Otherwise RBI will be busy with their own accounts, not not able to concentrate or take care of the banks, or supervision may not be possible. So that is the reason. Okay, now write the functions of RBI. Functions of RBI. First one, it is a currency authority. Just write currency authority. It is a sole authority to print money under MRS. What is MRS? Minimum reserve system. So RBI is the sole authority to print the currency. So under this, all the types of currency like 2 rupee, 5, 10, etc., all these can be printed. Now government government is printing 50 paisa and 1 rupee coin, right? Rupee 1 is actually printed by the government. Which ministry? Finance Ministry. Finance Ministry. Okay, so who signed here in this 1 rupee and 50 paisa? Finance Secretary. In case of other notes, it is RBI Governor. In case of 50 paisa and 1 rupee, it is Finance Secretary will sign this. Under which act this 50 paisa and 1 rupee is actually printed by the government, central government? Which act?
Coinage Act.
Currency and Coinage Act. Currency and Coinage Act. Okay. So that's about the first point. Currency authority, sole authority to print the currency, print the money. Second point, you can write governments, banks. So every state government and central government have to have an account with RBI. So you can write governments bank. The central, under that you can write the central and all state governments have to maintain account with RBI. Central and all state governments have to maintain account with RBI. All financial transactions of the government are undertaken through RBI. One more line you write, it advises government on financial issues. It advises government on financial issues. One more point, it lends to government. As well as manages the government's borrowing program. It lends to government as well as manages the government's borrowing program. Okay, how the government's borrowing program is managed? How it is managed? Through bonds, right? Government securities, by selling and buying government securities. So if you need to collect money, RBI will sell the government security and collect money and will give it to government, right? So just write there, it manages government's borrowing program. Through sale and purchase of government securities. So when you sell the government security, you will get money and you will collect money and you will give it to government. Okay. So the government securities will be like this. Let's suppose this is GSEC. So let's say 100 rupees printed here. Let's suppose 100 rupees printed. So this will be through auction process only. This will be selling. So like different banks will participate in the auction. For example, SBI. Let's say SBI is offering 93. PNB is offering, let's say, 94. And ICICI is offering 95. Okay. Then HDFC is offering, let's say, 91. So these are the different offers. So RBI will sell to whom in this context? ICICI, because ICICI is offering maximum. Okay. So what is the return for ICICI? This difference between the face value, that is 100, and the price at which the bond is bought. So that around 5% return will be there. Okay. So this is actually the return that ICICI get upon this bond. Now why ICICI? If ICICI can spend this money rather than ICICI is getting 5%, but ICICI could have better spent that money by lending it to the normal consumers rather than buying government securities, right? ICICI can charge around 14%, 13% interest from the normal customers if you can lend those money. But why ICICI is buying government security? Any logic?
So because it's safe and sovereign.
No, not that. Actually, there is something called as SLR, statutory liquidity ratio. We will discuss this in detail in the next session. So under statutory liquidity ratio, you need to maintain certain amount, right? So 20%, etc. you need to maintain. I'll tell you what is that percentage. So it could be maintained either in the form of gold or in the form of rupee or in the form of GSEC. So these are the three ways in which you can maintain this requirement, SLR requirement. So the problem is when you maintain this rupee, for example, this is 95 rupee, when you keep it here, there is no return. Rupee is idle. So that is why actually you prefer buying government bonds. So you will get at least 5% return. If you keep it in rupee, there is no return. Now why not gold? Gold will give you more return, but gold is not actually calculated at market price. It will be calculated as a constant or a fixed price. So you need more and more gold. So that is not required. Why it is not calculated at market price, if you ask me, it is because if you calculate it at market price, banks prefer gold here because gold will give you more return. So it will lead to import of gold, and that will affect the current account deficit, etc. There are a lot of problems. Don't worry about these technical words. I will be talking about all these words, and you will be clear with everything in the coming session. So just understand, now gold is not good for banks. Rupee is also not good for bank. So to maintain their SLR requirement, GSEC is required. So there was a question in prelims before, which monetary policy instrument forces the banks to lend to government, which is that statutory liquidity ratio. Because when the statutory liquidity ratio is there, it is actually forcing the banks to lend to government. How that lending is happening? By purchasing the bonds. So you are actually forced to purchase the bond. Otherwise you have to maintain in terms of rupee. That is not going to give any benefit to banks. Now at least 5% you are getting. So you have no option. If RBI is asking you to keep 20% or 22%, you have no option. You have to keep this, and through that you are lending to government actually. Okay, so this is one point. So RBI is actually managing the borrowing programs of government. Okay, see, there was a proposal of PDMA, Public Debt Management Authority, for managing the borrowings of government. Okay, but this proposal was there in the budget 2015-16, but then later it was abolished. Okay, that plan didn't work well. So we are not talking about that. Anyway, I'll discuss about this PDMA later when we discuss about the public debt and everything. There was a separate institution which was proposed to manage the government borrowing program. Here RBI is managing the government borrowing program. Okay, so RBI is having many other roles. So government borrowing program should be done by some independent institution. That's why PDMA was proposed, but it was did not set up. We will come to that. Okay, it was that plan was dropped later. I'll discuss about this in budget. When we discuss about this public debt, I'll discuss this. Third one, bankers bank. Third function, bankers bank. Right under that, banks have to maintain accounts and reserves with RBI. Banks have to maintain accounts and reserves with RBI. Reserves means what? I'm talking about CRR. What about SLR? SLR is kept with the banks. I will discuss about this. SLR, where it is kept. CRR, where is it kept? I'll discuss this. So banks have to maintain reserve with RBI. In bracket, if you want, you can write CRR, cash reserve ratio. This I'll discuss in the next session. Second point you write under bankers bank, it lends to banks in good and bad times. Okay, it lends to banks in good and bad times. Now have you understood this point which I have told you? The question was which instrument compels the banks to lend to government. You understood what I mean to say here. Which instrument? SLR. Why SLR? Because you need to maintain SLR. It is a condition, right? If you need to maintain SLR, either gold or rupee or bonds or government securities, right? So gold, I have told you, it is taken at a constant price. So this is not going to give you much return. Rupee will not give you any return at all. It is both are not going to give you any return. So government securities will give you return. So government security will give you some return, even though it is less 5% only, but that is giving you some return. So banks prefer to keep or maintain SLR in terms of government security. So that's why I've told you RBI is managing the borrowing programs of government. So PDMA we will discuss later. Public Debt Management Authority I'll discuss later. Now you don't worry about that. When we discuss about budget, I'll discuss over there. Okay. So now this one you write bankers bank. It lends to banks in good and bad times. That means lender of the last resort. Lender of the last resort. Okay. It is also called, it is written, it is also called lender of last resort. That means RBI will help the banks if there is no other option. Okay. So one more you can write, it provides clearing house facility. It provides clearing house facility to banks for settlement of their claims on each other. For settlement of their claims on each other. Like ATMs, check, etc. It provides clearing house facility to banks for settlement of their claim on each other.
Excuse me, sir.
Yes.
Sir, can you please explain this clearing house system?
Clearing house facility means your bank is SBI and somebody is paying you who's having an ICICI account. Okay, so he is giving you a check of ICICI, so you will deposit here and they will settle the claim mutually, right? That's what clearing house facility. Similarly, you may have SBI card, ATM card, so you can use this ATM card in ICICI and you can withdraw money, so they will settle that money withdrawn and everything. That's what I mean by clearing house facility.
Okay, thank you, sir.
Okay. One more point you can write, it also advises banks to do and not to do certain things. It also advises banks to do and not to do certain things. They're on moral grounds. Sometimes punishments will be there, sometimes punishment will not be there. Punishments could be in terms of cancellation of licenses, etc. Just don't worry about that, we'll discuss that later. Next point, fourth point, supervisor of banks. Under that you can write, it regulates banks as well as financial institutions. It regulates banks as well as financial institutions. Financial institutions. If you can write financial institution, you don't want to write completely like that. You can write like this, partially or wholly financial institutions. Some financial institutions are regulated by some other bodies. I'll discuss that when it comes to financial institutions. Like mutual fund will be regulated by some SEBI. Okay, ULIPs will be regulated by IRDA. Like different regulatory bodies are there. So you can write like this, it regulates banks. Banks complete regulation is RBI as well as partially or wholly other financial institutions. Next point, supervisor of payment system. Supervisor of payment system. Under that you can write, it regulates norms dealing with transfer of funds within and outside the country. Dealing with transfer of funds within and outside the country. Under that you can write means of payments. We will see means of payments. You can write there check. First one, check. There is no need of explanation here. Second one, demand draft. Okay, demand draft. One more you can write, put a comma and you can write pay order. Pay order is also similar to demand draft only. It is a draft, but it is within the city. Okay, within that particular city, pay order. It is similar to draft, but within a city. Third one you can write NEFT, NEFT, National Electronic Fund Transfer. National Electronic Fund Transfer. Fourth one, RTGS, Real-Time Gross Settlement System. Real-Time Gross Settlement System. Okay, what is the difference between these two? RTGS, it's more than 2 lakhs, right? It is for more than 2 lakhs, and every time on spot payment is done. Let's suppose it can be, when we talk about RTGS, let's say 2 lakh, 3 lakh, okay, and then 3 lakh. So all these done on spot. But when it comes to NEFT, here any amount is possible, less than or more than 2 lakhs is fine. So for example, between SBI, if you take SBI on one side and ICICI, okay, so there is a transfer of, let's say, 2 lakh from SBI to ICICI, and from ICICI to SBI there is a 3 lakh transfer and one more 3 lakh transfer. So after some time what will happen is 6 lakh is going to SBI and 2 lakhs is coming from SBI, so the net will be credited to SBI, that is 4 lakh. This is what actually happening in NEFT. Okay, so after some time this 4 lakh will be the on-spot transaction will not happen like this, that will happen under RTGS. So here that net amount will be credited to SBI in this case. So RTGS is available for 24 hours. Okay, NEFT advantage is any amount can be settled. RTGS in case of more than 2 lakhs. Now one more you can write there, IMPS, immediate payment system. IMPS, immediate payment system. See, it is like RTGS. It is any IMPS is available 24 hours, so similar to RTGS, and any amount can be done similar to NEFT. So actually combination of both you can see here, immediate payment system. Next you can write under this different, we are talking about different means of payment. We have done check, demand draft, NEFT, RTGS, IMPS. Next is internet payment gateways. Internet payment gateways. What are they? The Visa, Master, RuPay cards, etc. Bracket you can write Visa, Master, cards, all these. I'm talking about card payment system. Internet payment gateways. Next one you can write e-wallets like Paytm, etc. Okay, e-wallets, that is also a means of payment, e-wallets. Next one you can write postal order. Postal order is this one, similar to draft, but it is actually issued by post office. Okay, so it is the draft of post office. Postal order. Postal order is the draft of post office. Money order. And you can add BHIM, UPI, all these also. So I'm just talking about different means of payment. So next function, custodian of Forex reserve. Custodian of Forex reserve. Custodian of Forex reserve. See, only RBI and the RBI authorized agencies can deal with Forex. Okay, so I've told you yesterday, when Forex, what was the reason for increase in money supply in the post-reform period? It is basically increase in Forex, right? So when Forex is coming, let's suppose a foreign investor is coming, he is coming with dollar and he will give it to RBI or RBI authorized agency, and this dollar will be converted to rupee, and that will be invested or that will be coming into the market, and that will increase money supply. This is what we have discussed yesterday. So RBI have to print equal amount of currency, either print or existing currency with RBI have to give to this dollar incoming or the Forex incoming, and that is the reason, and that will be coming to the market. That's why money supply will increase, right? So RBI is the sole authority to deal with Forex reserve. RBI and RBI authorized agencies. Okay, so that is a very important function. So why, I've told you yesterday why Forex inflow actually increasing inflation, because it increases money supply. When money supply is increasing, what will happen? Purchasing power will increase. If this is increasing, aggregate demand in the market will increase. That demand increase means prices will increase. Price increase means automatically inflation. And withdrawal of Forex, that is not desirable, but inflation will reduce, not desirable for many other reasons. All these we will discuss, okay? All these we will discuss in inflation. Now just to understand, as a function of RBI, it is custodian of Forex reserve. Next point, exchange control and management. Exchange control and management. So this 1991, before reform, what exchange rate system? It is fixed, right? Then for some time we have followed LERMS, that is liberalized exchange rate management system, and then we went for floating. Okay, so floating exchange rate system. So here it is not purely market float, it is actually managed float. Who's managing? Government is managing. RBI is managing on behalf of government, right? Like I'll show you one example here. Let's suppose if you draw a demand supply curve, okay? So here it will be the quantity of dollar demanded and supplied. So let's say this is the demand curve of dollar, demand of dollar, and this is supply of dollar. Okay, so let's say this is a normal equilibrium position. Now you see demand, dollar is being a hard currency, the demand is always more. Okay, so this is a quantity of demand, the quantity demanded of dollar supplied, and here it is the price of dollar in terms of rupee. Hard currency means, I'll talk about that. Hard currency means, you can use that currency everywhere, the transactions and everything will be easy. You can use that in Forex also. That will be counted in Forex, like euro, pound sterling, all these are hard currencies. Japanese yen. Okay, so everybody demand that currency actually. So this side price of dollar in terms of rupee. Okay, so here quantity, this is supply of dollar, this is demand of dollar, so this is the equilibrium position. Let's say this price at this point is 67 rupee. That means $1 costs 67. Now demand for dollar will increase because dollar is demanded always, as it is a hard currency. So demand curve shift rightward. So demand curve shift rightward means what will happen now? Supply of dollar remain the same. So what will happen? The price of dollar in terms of rupee is increased, and that's how it becomes 75. So this situation is what we call as rupee depreciation, because from 67, earlier $1 is 67, now if you need to get $1 you need to pay 75. So that lead to rupee depreciation or appreciation of dollar. Okay, now why this situation happened? This situation happened because there is an increase in a demand. But let's suppose this is 10% increase in demand. Now if RBI can provide supply of this 10%, do you think this increase will be there? No. So what RBI can do here is, RBI have to provide supply for this 10%. That means same, this much supply RBI have to give. So you can see the new meeting point. This is a new point. So you can see price remain the same. So this is how RBI can actually manage the exchange rate, but there is obvious limitation. We don't have too much Forex. Okay, if we have too much Forex, it depends on the demand of dollar, RBI can pump the dollar in the market and RBI can manage it. But that is not possible. But there is a provision that we can do that. That's why our system is managed float, not complete float. And that's what I've told you here, exchange rate control and management. Apart from that, with respect to convertibility also, RBI have full control. Okay, convertibility, all these concepts, you don't worry about that. When I'm talking about the functions of RBI, I'm taking different terms, but all these have to be discussed in different chapters. So even all these, this I will be discussing separately later. All these liberalized exchange rate management system, floating, fixing, all these will be discussed later in detail. You don't worry about any of the terms which I'm using, just understand RBI control all these. Okay, so just write under that, it regulates norms dealing with conversion of rupee. It regulates norms dealing with conversion of rupee into foreign currencies and vice versa. Into foreign currencies and vice versa. So rupee to dollar, dollar to rupee. That conversion, who is regulating? RBI. This is called convertibility. This is called convertibility as per the provision of Foreign Exchange Management Act 1999. This is called convertibility as per the provision of Foreign Exchange Management Act 1999. It also stabilizes exchange rate of rupee. It also stabilizes exchange. That is what I have explained here. This is how RBI can stabilize. How RBI can stabilize? If the demand for dollar is more, what will happen? Rupee will depreciate. So what RBI need to do? RBI have to supply dollar, RBI have to pump dollar, so RBI can manage that. Okay, so it also stabilizes exchange rate of rupee. Next point you write. So that is one function. Next function, it represents Government of India. It represents Government of India in international financial institutions like IMF, World Bank. It represents Government of India in international financial institutions like IMF and World Bank. Okay, see, in IMF and World Bank, you have to send your representatives. IMF, you know who is the head of IMF? The post is actually managing director. World Bank, the position is actually president. Now below president and below managing director, there is board of governors. Board of governors, or basically board of directors are there. Okay, so for this, actually every member country have to send two representatives. Every member country have to send two representatives. One will be the governor and the other will be the deputy governor. Deputy governor, I am talking about their position here. So who will be the governor from India? It is finance minister. Who will be the deputy governor? It is RBI governor. So don't be confused. This deputy governor is in this context. Here they are deputy governor but actually RBI governor. Here governor but actually finance minister. So finance minister is actually the ex officio governor when it comes to representation to IMF and World Bank, and RBI governor will be the deputy governor also. Okay, is that clear? So India will be represented by these two people in the board of governors, board of directors. Then below this there is board of executive directors that will have total 24 members. We will discuss about all these things in international institutions. Out of this 24 members, 19 will be elected and 5 will be nominated by the largest quota holders. But in IMF recently there was a change from 2015 onwards that entire 24 will be elected. So all those things I will discuss later. So here what I am saying is RBI represent India in the international institution. That's enough for you. The detailed discussion I will take in the different corresponding modules. I will do that. It is going to be a very lengthy class. So we will do everything. Okay, so next one, publication of monetary data. Publication of monetary data. In that you can write first one, report on currency and finances. Report on currency and finances, which is an annual report published by RBI. Report on currency and finances, annual report published by RBI. That's an annual report published by RBI. Second report you can write, RBI Bulletin is a monthly magazine of RBI. RBI Bulletin is a monthly magazine of RBI. Okay. Now 10th point, next point, RBI is the controller of credit. RBI is the controller of credit. Do you remember the credit creation process I have explained yesterday? So I have told you 100 rupee printed by the government or RBI. What is the purchasing power of this 100 rupee? 560, right? So this 100 is actually your M0. What is M? M is 5.6, right? So M0 into M will be 560. M is actually 5.6, money multiplier. So why this 560 value is coming? Because different banks will keep on, this 100 rupee will go to some bank and that bank will keep the requirements, reserve requirements, and will lend balance, and that will go to another bank, and the banks are the creators of the credit. So how banks are becoming the creators of credit? If RBI is asking the bank to keep entire 100% with banks, then bank cannot create credit, right? So yesterday I have discussed about 20% bank will keep and 80% bank will lend. So if RBI is increasing this 20 to 25%, what will happen? Do you think this value will be correct? No, it will be less than 560. Similarly, if reducing to 15%, then this 560 will be increased to some 600 plus. So that's what I'm saying. RBI can control the credit creation. Although banks are the credit creators, but who control it? RBI control it through SLR and CRR. Okay? Is that clear? You write one sentence over there. It regulates credit creation capacity of banks. It regulates the credit creation capacity of banks through monetary policy. Through monetary policy. Okay, now next point, 11th point, developmental role. See, it is not only government, RBI is also responsible for promoting development, right? I've told you RBI is part of government. RBI we cannot treat as bank. RBI is part of government, so RBI is also responsible for the development. Under that you can write first point, ensuring credit and financial services to vulnerable section. Ensuring credit and financial services to vulnerable section. Right, it's RBI will do that. In bracket you can write financial inclusion. Financial inclusion. Second, under that you can write second one, promoting effective mobilization of savings for capital formation. Promoting effective mobilization of savings. See, the savings will be mobilized from the household because households are the savers. So from households you will mobilize money and you will be giving it to the firms for the investment purpose. So that will lead to capital formation. Investment is capital formation. Okay. So promoting effective mobilization of savings for capital formation. And what is the role of financial institution in general? When we talk about financial institution, the role is basically they are the intermediary between savers, that means households, and the firms. So they will do the investment. So savings, it will be mobilized, and this financial institution will lend it to the firms. So from household they will take it and they will lend it to firms. So financial institutions are basically intermediaries between households and firms, or savers and investors. Okay. Next, in developmental role, you can again write inflation control. Inflation control. Inflation control.
So I have a question.
Tell me.
So how does RBI promote or ensure financial inclusion?
See, RBI can give different guidelines to the banks in terms of KYC norms. For example, when we talk about priority sector lending, all these are, banks have to comply to these guidelines which are given by the Reserve Bank, no? Okay, so the KYC norms for agricultural loans will be very less. So this much credit has to be given to 40% has to be given to priority sector lending. This kind of guidelines RBI will give. So banks have to follow that. That leads to financial inclusion. Financial inclusion includes access to credit also.
Okay. Yes, sir.
Okay. So priority sector is one important point. Apart from the general guidelines regarding opening of accounts, etc.
Okay, sir.
Now, yes, tell me. Yes, you can tell. Priority sector, what are the priority sectors? Education, agriculture, etc. We will discuss about that in banking. Actually, every bank have to lend 40% to these priority sectors. No. Okay. So, next topic, monetary policy. A very important topic, you will expect questions from here. Monetary policy. Okay, just write one line there. It is a component of economic policy. It is a component of economic policy through which central bank regulates money supply in the economy. Central bank regulates money supply in the economy. You see, what is the main reason for inflation? What is the main reason? Money supply, right? When money supply is there, what will happen? See, when money supply is high, purchasing power will be high, right? So that lead to increase in demand, and that lead to price increase. Now your objective is to bring down this price increase. So what you need to do, you need to tackle money supply. So you need to reduce money supply, and to reduce money supply, there are certain measures. So that's what you are going to do through monetary policy. So to control inflation, you are going to use monetary policies. Okay. So next one you can write, it is a policy through which central bank uses instrument under its control, various instruments under its control, like CRR. Okay, this is one instrument. If you want, you can write in bracket SLR. We will discuss this tomorrow, okay, in detail. SLR, reverse repo, okay, repo rate, okay, reverse repo rate. Rather than saying repo rate and reverse repo rate, repo and reverse repo, MSF, all these we will be discussing in detail. Okay, so these are the different instruments that RBI have to control money supply. So what we have written, it is a policy through which central bank uses instruments under its control to regulate availability, cost, and end use of credit. Availability, cost, and end use of credit and currency in the economy. So when we talk about availability, I mean to say credit. So whether it is available or not. And when we say the end use, it is a final use of the purpose. Okay. And what is cost? Cost is actually interest. So all these are actually decided by RBI through the monetary policy measures. Okay. So for example, when repo is increasing, what will happen? Interest will increase. That means cost of borrowing will increase. The credit availability will also be less because interest is more. Like that. So RBI can control all these. RBI can regulate credit, end use, and cost. Everything can be controlled by RBI through monetary policy. Give a heading, objectives of monetary policy. Objectives of monetary policy. Okay, what is that last line? It is a policy through which central bank uses instruments under its control to regulate availability, cost, and end use of credit and currency in the economy. Now, objectives of monetary policy. First one, price stability. Price stability. So when we talk about price stability, what does this mean? Basically, inflation control. I'm talking about inflation control. Second one, to stimulate economic growth. I've told you RBI is having the developmental role also. So you can write here, to stimulate economic growth. This is also the objective of RBI because RBI is part of government. Okay. Now don't you think 1 and 2 are contradictory? Can we achieve both together? Here, when there is a growth, automatically price will go, right? Okay, now if you remember when we discussed about demand supply, I've talked about this. This is, let's say, this side it is price, and you remember we have drawn some demand curves like this here, quantity. So this is demand of person A, demand of person B, and this is the market demand. Okay, and I've told you the demand of market is actually the demand of A plus demand of B. Okay, so that here we have already discussed that when I've discussed about demand supply. So here what I'm saying is when we talk about these monetary policies, etc., I will be using these concepts are macroeconomics. So here on the x-axis, rather than writing quantity, I will be writing national income, entire income of the country I'm using. And here I'll talk about average price, so price level. Okay, and demand, I won't use demand, I will use aggregate demand. That means the total demand in the economy. And supply, I will use aggregate supply. That means the total supply in the economy. So this is a macroeconomic concept. Earlier we have discussed about microeconomic concept. So let's suppose this is a current equilibrium position. Now, when money supply is there, right? When money supply is there, what will happen? Purchasing power is high. So what will happen? Demand, aggregate demand will increase. So demand curve shift rightward, right? So demand curve shift rightward means you can see there is an increase in price. So this is inflation. But what is a positive here? Positive here is this. You can see there is an increase in what? National income. So the growth is also increased. Okay. Now, if to control this inflation, I've told you need to reduce the money supply, right? So if you try to reduce the money supply, what will happen? The demand will come down. So you can see here, the demand will come down, the demand curve shift leftward. So this is a new point. So actually you can see price is decreased, but growth is compromised. So what I'm saying is both cannot be achieved together. So what should be the stand of RBI? RBI should go in a balanced way. So RBI was going in a balanced way only till 2015 and giving equal importance to inflation as well as growth. But from 2015 was a committee, Urjit Patel committee. We will be discussing about all these in detail in the coming session. Urjit Patel committee in inflation I'll discuss. So Urjit Patel committee said you focus on inflation targeting. So price stability is the main function of RBI. So after that RBI is more focusing on inflation control. So is that clear? Both cannot be achieved together. Okay. So even if slight moderate inflation is there, it's okay. 4% inflation is acceptable. And plus or minus 2 is okay. 4 plus or minus 2 is okay. I will come to all these in detail in the coming sessions. So whatever I'm not explaining here, you don't worry about this. I'm making a reference so that we are going to cover it in the coming sessions. Whatever is required at this point of time in this module, we will cover in detail. Some small references which I'm making, I will cover it in detail in the coming sessions. All these will be explained later. All these diagrams, you don't break your head on this if you didn't understand now. Okay, so first function, price stability, objective, second objective to stimulate the economic growth. Third objective, stabilization of exchange rate. Stabilize. See, this is what monetary policy dilemma. This one we have discussed. Monetary policy dilemma. Because if you try to control inflation, promote growth, it will lead to inflation. So monetary policy depreciation. But let's not discuss about. Okay, so third one, stabilization of exchange rate. Stabilization of exchange rate.
Hi, sir.
Yes.
Is it through the selling of Forex that you have told? Whenever demand increases, they sell the Forex deposits. That's how they stabilize the exchange rate?
Yes. RBI can sell that in the market. So supply will be there. When supply is there, then you can manage it.
Okay, sir.
Fourth one, strengthening financial system. Strengthening financial system. Fifth one, employment generation. Okay. Any doubts? So far, what we have done, is there any doubt? We can continue the discussion tomorrow. So if you have any doubt, you can ask me now.
Sir, how employment generation can be the objective, sir, if growth is not the objective?
Growth is also objective. That is the second objective.
No,
But
no.
prime objective is inflation.
Okay.
Everything. Now, you can even write etc. You can write unemployment, poverty, inequality. All these are objectives of RBI. Whatever are the objectives of government, that is also the objective of RBI.
Okay, sir.
Okay. Any doubts?
Hello, sir.
Tell me.
Sir, but if RBI focuses on stimulation of economic growth, that will naturally increase the purchasing power of people. So they will cope up with the inflation.
That's what I'm saying. Both cannot be achieved together. But now RBI's main focus is on inflation targeting. Inflation.
No, sir.
Only
I am
after.
saying. Yes, sir. I am saying that if RBI focuses on stimulating economic growth, then ultimately the purchasing power of people will increase.
Yes, that lead to inflation.
That will lead to inflation, but that will also cope up with the inflation, no? Like if I have higher level of income, I'll be able to pay more.
No, but not everybody will be getting higher level of income. No, not everybody will get the benefit of growth.
Okay.
Trickle down is not properly happening. That is a problem. Inequality, when the growth is there, actually inequality in India is increasing. The beneficiaries are not the lower sections.
Sir, I lost your feed.
Yeah, effectively the purchasing power of the lower section will decrease drastically when inflation is there.
Okay.
Upper sections, their income may increase, but lower section, the income won't increase as like the upper sections.
Okay.
Okay. Tomorrow we will see the monetary policy measures, very important area that we will discuss tomorrow. All these bank rates and everything we will discuss. Any doubts? Any other doubts?
No, sir.
Can we stop?
Okay, sir.
Okay, sir. Sure, sir.
Okay. Bye.
Bye, sir.
Yeah.
Bye, sir.